Hey guys, today we're going to be doing the analysis on Paycom software. And Paycom software is a software that businesses use in their human resources for payroll. So, in any event, Paycom dropped yesterday around $90 unexpectedly. It was because of an earnings report, but it wasn't an earnings report that came out and said that they lost money for the year. They actually made money for the year, but they didn't make as much money as they usually do. There's another guy who speaks on stocks and issues of that message. He actually did an excellent video explaining what happened to Paycom that made their stock price drop and things that are up and coming with that company. I will leave the link to his video in the description. But let's get started with my analysis. So, in any event, today we're going to look at how Paycom has done over the last 5 years. However, if we look at them today, we see that this company moved up today. So they really hit a low yesterday, but today they're up by $11.96, almost $12, and the percentage is 7.94%. So now take a look at the company, and these numbers were actually from yesterday when they dropped. Like I said, they moved up a little today. But as of yesterday, I updated this analysis to reflect the current price and PE yesterday. The earnings per share was $5.44. The current price was 156.71 and the current PE was 28.45. Now, I feel PE can give you an idea of exactly how low your stock is going to fall from year to year. Some companies, their PE may be pretty low throughout the year. It could drop to like 5 or 10. But companies that are in high demand, even their low PEs are high. And Paycom is one of those companies. Their low PE in 2018 was 34.28. 2019 it was 37.60. 2020 it was 66.90. 2021 it was 90.41. Pretty high. And 2022 it was 53.57. I usually can tell how low a stock is going to drop to by multiplying their low PE by the earnings per share. So the lowest PE would have been 34.28. And if I multiply 34.28 times 5.44, that brings me to 186.48. Well, this stock dropped even lower than that. It created a new low PE. It was at 156.71 yesterday, which means either of two things are going on. Either it's a horrible company now, or it's a great company that you can catch on sale. So let's look at how they've done over the last 5 years. In 2018, their low price was $80 and the high price was $162. I'm rounding off. 2019, the low was $116, the high was $278. 2020, the low was $164, the high was $463. 2021, the low was $304, the high was $551. And in 2022, the low was $259, the high was $403. And now they're at $156. So we could say, okay, how high is this stock going to move? I'm going to do my own analysis of how high the stock price can go, and then I'll show you Yahoo's analysis. So, in 2018, from the low to the high, PE was 35. It's a lot higher in 2019. A lot higher in 2020. And this was 30. So I'm going to go with the lowest of them. In 2022, it was 30. So let's say I say 28.45, yesterday's low PE, plus 30 equals 58.45. So if it moves up to 30 again, which was the lowest of it to move up for PEs in the last 5 years, and I multiply that by the current earnings per share, 5.44, from my analysis, this stock can move up from its current price to $317.96 in the next 12 months per share. So let's look at that again. The current price right now is $162.65. With my analysis, it can move from there to $317.96 in the next 12 months. Now let's see what Yahoo's analysts say it will move up to. Yahoo's analysts say it will move up to $379.50 in the next 12 months. So not far off from mine. A little high, but not very far off from mine. So now that we've looked at where this stock could possibly go per share, now let's do some analysis on the company. In 2018, the company made $566 million, and they kept $137 million in profit after paying all their expenses. That was a 24.20% profit margin. In 2019, they jumped up 737 million in terms of overall sales or revenue. And they kept 180 million in profit after paying expenses. That's a 24.48% profit margin. 2020, now remember this was COVID year. They made even more in terms of revenue, 841 million. But they didn't keep as much in terms of profit after paying all their expenses. So that year they made 143 million in profit. It was only a 17% profit margin. 2021, they made $1 billion in terms of overall sales and revenue. And they kept 195 million in net income or in profit after paying expenses for 18.57% profit margin. And in 2022, 1.3 billion in overall sales and revenue with 281 million in profit after paying expenses for a 20.46% profit margin. So their profit margin is decent, around the 20s. It dropped in 2020 and it was still in the teens in 2021, but it's working up, so we could say it's been around that 20 range. Now, let's look at their return on equity. It's return on what the shareholders own. In 2018, return on equity was 40.95%. 2019, 34.29%. 2020, it was 21.88%. 2021, it was 21.93%. And 2022, it was 23.79%. Now, as for return on equity, it can be a little off when you're doing over like 200% debt to equity, which you see below, which speaks about the number of debt that the company is carrying. However, if we look at this debt to equity, it was 354% in 2018, 372% in 2019, 297% in 2020, 259% in 2021, and 259% in 2021, and 229% in 2022. They are actually decreasing their debt from year to year. From 2018 to 19, it went up a little. Since then, they've been decreasing it every year. And as they're decreasing it, I think the return on equity is becoming more realistic. It will be around that range, which was 2022's 23.79%. We're going to go down to the balance sheet. Speaking of debt, And we see that the balance sheet has four things, really two, but we can break it down into four. The balance sheet compares the assets that the company has to the liabilities. In other words, what they own and what they owe. Assets may being machinery or whatever, maybe computers, whatever things they own, against what they owe. They break down the assets and liabilities in two groups. Current assets, things which are owned and owed for under a year, and total assets, which includes long term. So if we look at their current assets exceeds or is higher than their current liabilities all 5 years, which we want to see. Not by much, but it exceeds it. And their total assets exceeds their total liabilities. So in 2022, it was almost by half. So this is not what I would call a spectacular balance sheet, not what I would call a great balance sheet, but it's an okay balance sheet. It's a passable balance sheet. This company paid a dividend in 2022. As we see, they didn't pay a dividend the previous years, but they paid a dividend in 2022. And speaking of dividends, we see that they announced a cash dividend of 37 cents with an ex date of November 24th. And what that means is if you buy any shares of Paycom on November 23rd or prior to that, you would be eligible for that dividend. In 2 of the last 5 years, they bought back more shares of their own stock, which we always love to see. 105 million worth in 2018, 52 million worth in 2020. And in 2022, they sold more shares of their own stock, which we don't really like to see. 94 million worth. Now, when a company has paid off all their expenses and then they have their profit, they have their free cash flow, they can pay the dividends to the shareholders from that free cash flow. One thing that you want to do is you want to make sure that this company is paying the dividends from the free cash flow. Because if they're not doing that, what are they doing? They're probably borrowing money just to pay you a dividend. And what does that mean? That means it may come to the point where they have to stop the dividend because they can't afford to keep borrowing money to pay you dividends. So this company had 124 million in free cash flow in 2018, 131 million in 2019, 133 million in 2020, 198 million in 2021, and 232 million in 2022. And notice they had free cash flow after paying the dividend. They still had money left over. So let's go to our summary of all of this. This company has 15.43% of their shares are owned by insiders. That means people who work in the company or are part of the company. That seems like a small number, but it's actually a very high number. If we look at outstanding shares, it tells us this company has 57.95 million outstanding shares out there. 57 million shares. And 15% of that is owned by people who work in the company. I analyze a lot of companies, and generally, the people who work in the company may own 1%, less than 1%. If they own 2%, that's a pretty decent number. But for this company, it's 15.43. And institutions owns 81.41%. 81.41% owned by institutions. Institutions are banks and other large institutions. The dividend yield that they're currently paying out, it's not much, 0.57%. But the question is that going to increase moving forward? Are they going to start paying a dividend every year or quarter or whatever? The president, CEO, and chairman of the board of Paycom is Chad R. Richardson. He served as CEO since 1998 when he founded it. He founded the company. He started it. He began in sales with ADP. Paycom is in the software application industry and the technology sector. Okay, guys, now we're going to jump over to the technical analysis and see what the candlestick chart tells us. All right, guys, let's look at the candlestick charts and see what we see for Paycom. And if we come back here, we see, wow, I can't see the top, but it was easily over $530. That was in November of 21. Came down, sort of moved sideways, came back up, was at 391. That was in August of 22. Sideways again, moved back up. This is, I believe, in 23. in July of 23, it was up around 368. Then from there, it went down and went sideways a little, dropped some more until this tragic week where it dropped dramatically. But as you can see from the fundamentals that we just went through, this is a solid company. The only thing that we saw an issue with was the balance sheet, and it wasn't much of an issue. Like I said, it was an okay balance sheet, not a great balance sheet. So, having said that, now let's jump over to the annual, the 12-month chart. And we see with the 12-month chart, this stock moved up. Let's see. This is 20. This is 19. So 20, even in COVID year, was moving up. It moved up a number of years, but definitely the last 2 years. This stock was starting to fly. Then in 2021, it started to come down, and it's been moving down ever since. I know that can look like a scary prospect, but the thing to remember and to keep in mind is that there's something going on in the economy right now. Not exactly sure what it is, but a lot of quality companies are falling these years. This year, last year, some the year before. I'm not sure if it's something going on with the administration and if that has to change in order for things to take a turnaround. But if we look at these stocks, the most fundamentally sound and quality companies, they've been falling for like the last 1 or 2 years. If it is the administration, be sure and believe that the people carrying the money are probably going to get together and figure out a way to get this president out of there and get someone else in. I have no problem with Joe Biden. I like Joe Biden personally. I think he's a great guy. But now we're speaking objectively about our money. And if the administration is the problem, why all of these companies are suffering, I feel we're going to see a turnaround when the election comes. I hope it's not 45, but I feel we'll see a turnaround. In any event, I'll see you guys in the next video.